also to take a look at earnings season, which will kick off now too, as we'll take a look at a lot of the banks, right? We're looking at some of the names on the move and some of the sectors as well. Sam, I think the first topic of business should be the immediate move that we're seeing in the markets today. The Dow was up 4 or 5 trading days. On Friday, it sort of petered out because of a weaker than expected jobs report. People came in feeling a little optimistic today, only to see the markets turn back into the red and led down by utilities, communication services, financials, and healthcare. Is volatility or sell-offs just sort of the name of the game here?
Hey, Nicole, good to talk to you again. Well, volatility and October do tend to go hand in hand. If you look back in time, what you find is that the volatility in October is almost 4 times as high than the average for the other 11 months of the year. So we have very high volatility in October. And so I would tend to say that what we're seeing right now is simply traditional for this spooky month of the year.
Okay. So we have a few topics to discuss the spooky month of the year. You mentioned the phrase secular bull market. Explain to folks what that is and where you think we are.
Well, a secular bull market really is basically just a long-term bull market. A bull market, if it's cyclical, basically you have advanced 20% off of the prior bear market low. But until you recoup all that you lost in the prior bear market, you're still in just a cyclical bull market. Secular is when you then proceed and hit new all-time highs. But I think there's also, from a technical perspective, that you are other factors to differentiate between secular and cyclical. In my opinion, it really is just a matter of semantics. It's really a question of whether the market is heading higher and what will be driving it. And right now, we have an awful lot of headwinds as it relates to higher interest rates, oil prices, reductions in GDP growth prospects from supply disruptions, et cetera. So I think that this is likely to be a very challenging month.
Very honestly, it really is very challenging because of so many headwinds that we could so easily describe. You talk about cutting of growth rates. We saw that from Goldman Sachs today. You have higher energy prices, higher food prices, supply chain issues, questions about the Fed. It's all sort of facing us, and the market can't seem to take off. Every time it tries, everybody sells into the rally. That being said now, is there certain sectors that you like more than others based on the current situation?
Well, obviously, energy is the area that is showing the best technical strength and good reasoning for it. And it looks as if oil price targets are likely to continue to rise over the next several quarters. Our expectation is that we could easily be moving into the high $80 per barrel area just over the next several months. So it is an area of concern. Also, interest rates are creeping higher. We see the 10-year yield now above 1.6%, working its way up to 1.7%, with the Fed continuing to keep the short end of the curve where it is at the low point. That allows for a steepening of the yield curve. Traditionally, steepening of the yield curve tends to benefit the financials in general and the banks in particular. And so we are seeing some good fundamental and technical strength there as well. And then lastly, small caps. You had mentioned when you opened up the show that the Russell was the only one that was sort of keeping its head above water. And so if you're having a strengthening dollar, then that ends up benefiting smaller cap stocks, as well as the prospects that investors are rotating out of some of the shakier large cap issues.
Right. And we have a slew of earnings, right? A lot of the banks are reporting this week. Domino's Pizza will have a lot of fun with earnings this week. There are a lot of calls that maybe earnings they will just be less than prior quarters, and or guidance. I saw one article saying could be ugly. How bad is it?
Well, ugly is, everyone's the eye of the beholder, if you will. Certainly, we started the quarter with analysts expecting about a 26% year-on-year increase. Now that might look ugly compared with the second quarter, which was up 88.5%. But also last quarter was what? The 47th of 48 months, or quarters, I should say, in which the actual results exceeded end of quarter estimates. So that's a pretty good track record. 47 of 48 times in which company management were able to guide analysts lower and then beat on the quarter. Well, we're not really starting off all that well. Expectations were for 26% at the beginning of this quarter. Right now, we're now at 24.5%. And let's face it, when we had third quarter GDP estimates go from 7% at the beginning of the quarter down to about 3% currently, I think there are an awful lot of headwinds that could make that this quarter misses in terms of beating analysts' expectations.
I thought it was interesting where you talked about the sub-industries for strength for chemicals, movies, entertainment, and steel. And then you had the ones to the downside, auto manufacturers, reinsurance, housewares, specialties, seeing the deepest declines. Do you see this divergence continuing, or is it going to be rotating?
I think it'll probably be rotating because a lot of the improvements in the third quarter were because of benefits from COVID, the reopening, if you will, prior to additional worries about the Delta variant, et cetera. I mean, autos, they still have their problems because of the lack of semiconductors, and that will probably continue to put pressure there for quite some time. I think certainly with the prospects of higher transportation costs, supply disruptions, higher commodity costs, that could put pressure on many of the consumer areas, whether it's consumer discretionary or consumer staples. So I think you really do have to sort of cherry pick where it'll end up working out fairly well.